What the? I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's unreal and terrifying, and I want to understand this is something that's never happened before, and the reason you need to see this is because when correlations break down, it means markets are about to break down. And this is our Sunday show, the show that makes you money, where we like to look at the technical momentum and machine positioning to help you make more money trading and investing. Now let's head over to Goldman, where we find out that correlations aren't what they appear. As we look at the tactical flow of funds report today, we see on July 2017 is here, and this typically marks the end of the summer barbecue pool party theme for the S&P 500, going back as far as 1928. The S&P has hit 38 new all-time highs and on pace for the second most closing highs in the last 100 years. Only 1995 is shaping up to be stronger. The blow-off top is completed, up 13 out of the last 15 sessions. The summer slipper is engaged. The pain trade, according to Goldman, is no longer higher from here, as they are not looking to buy the dip. And this is at a time where retail investors are massively buying the dip, but we're going to give you some reasons not to, because it's not just correlations that are breaking down, it's flows that are about to break down as well. And August is a month for the largest equity outflows. It's clear to me that the passive inflows have slowed, and watch market on close imbalances. The market on close imbalances was minus $8 billion for sale in the last 3 days. This is not a good sign. And here you can see some of the risks as 5 stocks are now up 41%. The bar for those stocks heading into earnings is remarkably high. And by high, I mean they need to be great. And mega cap tech, we trust, and that's where everybody is invested. You look right now, $1 in the S&P 500 ETF SPY, which we're going to look at, 29 cents goes into the top 5 stocks. This a new record. How about this? You invest $1 in the S&P SPY ETF, 37 cents goes into the top 10 stocks, a new record. And again, what you're seeing here, and this isn't the chart that tells you correlations are breaking down. What this tells you is everybody is invested in the same 5 to 10 stocks, and this is dangerous. You know, people say we're not in a bubble, but look at this. 5 largest companies as a share of the S&P 500 total market cap. Here's one thing that's never happened before. We've never seen such a big bubble in top 5 companies in the history of the markets, and it's not even close. You can go back to 2008 and see it wasn't even comparable to the dot-com bubble, and right now it is, of course, the biggest in history. And look at the machines. We talk about machine positioned, and they are max long this market. This is a market that everybody is long heading into seasonally, which is one of the worst times of the year. We look at August flows that are out. Everybody crammed in. You wonder what can go wrong, and well, that's everything. And you can see here the machines are long the market as it grinds higher, showing the relationship between the CTAs, the risk parity, and vol control funds, all in line with the direction of the S&P. And if it turns to the downside, look for the machines to follow that trend. And U.S. and global equities typically see outflows heading into the election before returning to inflows again in November. The first half of 2024 saw second largest equity inflows on record, and right now people are buying stocks based on the presumption that former President Trump will once again take the White House. But historically, this is not the right move to make. It says you should wait. Money markets typically see inflows heading into the election and outflows post-November. We see U.S. bond funds are running in line with historical pace, with large potential post-election fixed income flows being set up. But look at this. The first 15 days of July have been the best 2-week trading period for the S&P since 1928. We're ending the best trading period of the year, 2024 being the 15th best start to the year on record. And here we know on the 17th, since July 1928, the 17th has marked the local top for this month, heading into material lower August. And that's why Goldman is now modeling a late summer equity market correction. And as we look at the correlations now, you start to see that it's not just the flows that are changing, something underneath has gone wrong. But one evidence here, you can see the August election year season seasonals are not good, suggesting that we're going to see a peak and a decline in stocks. So you notice here back in August, look for a rally after that and then a pullback into the elections. But we note that, of course, Zero Hedge from on behalf of Goldman says a market of stocks versus a stock market. The WTF chart of the day, as Goldman Sachs trader Brian Garrett does it again with a chart that actually shows the dramatic difference between the market and the market of stocks. The long-running correlation between the equal weight version and the market cap weight version of the S&P 500 is approximately 1. And look at this. Never happened before. That correlation is completely broken down and registers as close to zero as we've seen in the last 20 years. And when correlations break down, what we know is markets are soon to follow. So let's take a look at our screens here. We'll see what we think is going on with the markets. The equity market, we'll look at the bond market. We're going to review all the recommendations that Bank of America made last week and see if those are on track or if, as we called it, that was a wrong move at the wrong time. We see the S&P 500 momentum is still negative now as it flips over this week. The relative strength index cooling off from overbought territory, now down to 50 and decelerating. The moving average convergence divergence, or MACD, this is a technical signal showing a negative cross. Now, if you have trouble trading the technicals, we have something called Momentum Timer Pro. A lot of people, they get in late, they get out early, but we aggregate a bunch of these signals together and smooth it out with a proprietary overlay. And right now we see on the daily count, momentum has turned negative. You'll note that we got stopped out of this position a while back, and as we headed into, of course, earnings and the seasonal August decline, we said we're okay not being in this trade. Now, you want to know machine position, you want to get the lead on that. Look at here, we run a report on machine position. You see here the fast algorithm and the slow algorithm. The fast one, now we're starting to see signs that machines are looking to sell. This is a risk when the market goes down. Downside target, we're pointing at 525.17. Is take a look at the S&P 500, because we can note that as we look at the volume profile, and this is something you can turn on with your chart software, and I encourage you to do that. It shows where the most shares have been traded over a period of time. So we're looking at the last 10 days, and when you start to see a breakdown here, well, it means there's been more sellers than buyers, and when it breaks below that line, it tends to continue lower. Now let's zoom out to the 30 days, because you can see the next level of support where the volume's at, where we would look for buyers to step in. If they fail to do that, well, the risk becomes a material breakdown into this 525 zone, where you start to pick up some heavy volume on the 6-month chart around 521. We can see momentum here squarely to the downside on the relative strength index, as well on the MACD. If this trend continues into early next week, watch out for August. It's suggesting we're heading into a massive correction. At what point historically, then people come in and buy in a big way. Of course, the only thing against that will be if the economy breaks down. That will be our base case. This could be 1 year the markets don't follow their seasonal trends. But it's not just, of course, the S&P. Your question is, how do you make money with the information we're showing you on this show? And that is, we have our CTA Timer Pro. We look at the machine positioning, and when they get in deep short position and price moves against them, machines have to short cover, and that puts a lot of money behind a stock. And here we see right now we have 2 open trades going into the week. We're up on both of them, and we just added a trade to our subscribers this weekend. Maybe you like to trade the technicals. We've got 9 open trades on the book. 8 of them are up. We're sitting on an 89% win rate. You talk about how hard this is to do. Most traders have less than a 50% success rate. Some of the best traders in the world get somewhere around 50, and our reports give you that edge. Here you can see some recent trades stopped out for a near 4% gain on our CTA Timer Pro. And all we do, again, we scan the machine position, we look for when they're max short, and the report tells us when that change happens to give you the advantage. Here's a trade that got stopped out on Momentum Timer Pro, up nearly 2%. What a great trade that was. How do we know what momentum is? We look at it at different time scales, which is something people don't do. And when we see a change of momentum, well, what we do then is we give you, of course, the daily reports. We show you all the signals that are tradable. Regardless of the report, when it flags a tradable signal, we give it to you, and then I review it. That's the best part. That gives us the edge. I tell you what I think are the best trades. We give you the stop loss levels. We track them for our subscribers, and we update the stop losses each week. And you get a 30-day free trial. That's the best part. You too can make money. And yes, we make it that easy. You don't have to sit in front of your screens. You don't have to do what one of my buddies require you to do, and we give you 30 days free. Let's take a look here at the Nasdaq 100, because again, we talked about what B of A recommended last week, and using our own data on our own screens, we said, you know, we don't have the case for it. But here we can see some of the biggest companies that buy their stock back. That is in the QQQ. What do we know? Relative strength index. This is well below the S&P 500 at 43. Negative cross on the MACD. We picked up 3 consecutive daily sell signals on our Momentum Timer Pro, and we told you this was going to happen because momentum was stretched on every interval. Same with the S&P. Our downside target is now 448, and you can see, even though Goldman says the machines are long, one of the advantages of our reports is we give you the direction of the machines before they likely make the move. That's what gives us the edge. You can see the fast algorithm showing they've been selling down, or they should be selling down to around a 35% long position. Let's take a look at the charts here, because this is very clear. We see the same thing, the S&P, as we see a sell-off here going into that buyback blackout window. We had that late surge, and now, of course, as Goldman called it, right at near the top of the market. They said it was the 17th. Well, they got a little bit close. That was around the 10th and 11th. This is setting up a move to 448 down here, with the next big stopping point at 439. You look at the volume here, potentially breaking through several moving averages, the 50 and the 100-day, which would indeed set up machines to sell into that weakness. Now let's talk about, of course, some of these other trades from Bank of America. They said small caps. We said, well, be careful here. And this was definitely what you would want to call the Trump trade, as of course small caps did take off after he got elected, and that's giving people the hope that the same thing's going to happen again. So they jumped in early. That wasn't the call that we made. You'll notice the relative strength index up to 64. MACD's got a positive cross, but this thing is sitting near overbought territory and sitting on 16 consecutive daily buy signals due to a massive gap up move that we warned our subscribers to perhaps look the other way at. Again, machines are long here, momentum's long, setting up a downside move. Remember, where the major equity markets go, you're going to see small caps and follow. Let's take a look here. You saw this big move here on heavy volume as everyone started to buy into a second Trump presidency is going to be bullish for small caps. It came up and tagged that upper supply zone and found sellers immediately. If this reverses, look for this to come down in a material way. You're looking somewhere around 198, roughly 207 is our target. We'll zoom in here, and you can see that target clearly right here into the supply zone. If this doesn't hold and those buyers turn into sellers, look for them to follow the mega caps to the downside. How about the S&P 500 banking? Again, this was a big one on, of course, Bank of America. We did not like this, but it was a very short-term trade if anyone was going to take it, because after bank earnings, we don't think they're going to look that good going forward. And this thing is massively overbought on a technical perspective. We have no position here. Upside target, I've revised as higher, as it seems like the downside target is becoming possible. You look at machine positioning, it's long. Momentum is long. And are the banks going to hold out? Well, not likely. Even a cut in interest rates, we've made the case, is not bullish for the banks. Let's take a look here. It gapped up and jumped all the way into this upper supply zone. Let's zoom out, and you can see that's where sellers were before, and the insiders here likely looking to sell again, setting up a potential reversal of that entire move. Our case is it's going to get down to 46. That would be right here on that 5-year volume supply line, and you can see it very clearly right there that this could reverse. It's starting to follow this mega cap down as, of course, the market starts to come into the reality that flows are coming out and the economy is getting weaker. How about emerging markets? You want a good proxy of where the market is heading. Look overseas. Here you can see a relative strength index, again, cooling off. MACD negative cross. We've got some sell signals on Momentum Timer Pro. We almost hit our downside target. And this is a warning. You start to look at what happens overseas. You start to see it will affect the U.S. economy. Look at this. Our CTA Timer Pro selling across the board, coming off those long positions. Momentum is switching here to the downside. There's a huge risk. Of course, we know 2 into emerging market stocks. Let's take a look here, and what do we see? It rallied up and hit this zone. This will create a pullback opportunity. Investors have been buying the dip along the way, are going to look at this, but what you'll note is if this does not hold, if it breaks through this $42 range here where you see this, well, that is setting up a move lower. Our initial target is going to be that 100-day moving average, a breakdown of that, and you're looking at a retest all the way down here at 39.41. And as we zoom out, you can see small caps never, emerging market stocks, that is, never really rallied to keep up with the broad market. If they roll over, it means the global economy is indeed rolling over as well. Also, a great proxy of liquidity, that is. How about the bond market? Are they buying it? Well, we saw bonds sell off a little bit. Again, this is on the focus of the former President Trump. If he retakes the White House, will cause inflation. Of course, we know presidents don't have control over that. If they did, they'd bring inflation down. They get that is not one of their tools, but the market buys into that. Again, inflation is a function of growth and inflation expectations, not who's sitting in the White House. What we see here is our trade. We did not use stop losses, which we encourage you to do. We're down 1.15%. We did add a position, and right now that one is slightly up. Our upside target is still unchanged, downside target unchanged, and we model the machines should be fairly long here. Let's take a look at, of course, the bond market and see what it's saying about the broad equity market, because typically when stocks sell off, what we know is that bonds tend to perform well. And you can see it's got rejected right here, the 6-month volume profile. It got rejected there once, and you see price got driven all the way down here into the $90 range. This time it's getting rejected again. Will it push back down far, or will the buyers hold up here? At some point, it's going to break this 6-month volume profile line, and when you zoom out, what that's going to do is set up an initial move to 100, and if it breaks through that line of resistance, now you're looking to move all the way up here into the 108, 109 territory, and that's going to flag the U.S. economy right on a path to a recession. But of course, we talk about gold. Hedge funds are now going crazy long gold. We alerted our subscribers back on June 21st on our Momentum Timer Pro. Again, we don't just give you signals, we give you the logic behind it. And how about this? That trade is up 1.79% as people are going crazy bullish on gold. This is our actual stop loss levels that we give to our subscribers. We see that we're in the gain and we want to hold on to that gain. That's why we use stop loss levels. Upside target now 229 being revised higher, and downside target sitting at 215. Let's take a look at gold. Of course, we know everybody here is really bullish on that. It did hit a new all-time high, pulled back. I would expect buyers to come in here. You'll notice 215.43 is the 6-month volume profile line. If that holds, look for another run up here. But again, every pullback in gold is being bought. You can't dismiss that, but eventually the risks are pretty high here. If you see other things sell off and the economy slow, gold will come down with it. But GDX, it took off as well back on June 21st. We alerted our CTA Timer Pro subscribers to this. Here you can see that trade is up 8.66%. Is it that easy? Yes, it is. We've got our stop loss level set here. And again, we didn't hit our upside target, almost downside target 50-day moving average. We're going to look here at the miners because they tend to give us a perspective of where gold is going. And right now you just see 1 mild pullback and that got bought. I would expect any weakness here, just like gold, will get bought. The question is, will the flows of the market turn this the other direction? I know many of you are shaking your head saying, Steve, not a chance. Gold is going higher, and maybe it will. But one thing that could slow it down a little bit is the dollar. Here we look at momentum is negative on the dollar, but things are changing. We just put a buy it open on our CTA Timer Pro report over this weekend because things from machine positioning are trading. Now we also have for Momentum Timer Pro a dollar bearish position. So now we've got trades going both directions. As you know, we're very happy with our dollar bearish position. Our bullish one, we think is very short-term trade. We've got our stop loss. This is right from the reports. And here you can see the bullish momentum is negative. Bearish momentum is positive. But look at this. Machines are buying up here a little bit. And this could slow gold down just a touch. Let's take a look at where the dollar could move. I think this is a short-term play heading into the FOMC, but you can note here it has found support right in this lower level of volume here. And what that means is looking to move up. Let's check out the volume over the last 10 days there. You see it very clearly, the volume underneath. Let's zoom out to the last 30 days. So you see buyers coming in here, and I believe this is a setup going into the FOMC press conference. Our upside target's right here at 29 and unlikely to hold it much past that. Any notion that the Fed is going to increase rates here at this point is highly unlikely. Again, I see this as a short-term setup. Now, one we missed and told our subscribers to avoid but did take off was the Japanese yen. Momentum turned positive. The stock the ETF jumped up in a big way, but this one was too risky. I made the case that I just did not like the risk setup. The upside target was almost hit. We're setting up a downside move here, but this was a very, very quick one. Let's take a look at, of course, FXY, and we can see that indeed we called it somewhere down in here and it took off. Of course, again, the risk to this was that speculators would be right back in driving this down. For those who jumped on that trade, they made some money quick, but hopefully they're locking in that and either selling or raising their stop loss levels. The risk there is just too high, but that again is one of the value adds that we bring to our subscribers. But now you can see, as Goldman is suggesting, we've got a breakdown in correlations between the S&P 500 equal weighted and the market cap weighted. We're seeing seasonal period now start to move toward August where flows come out. All the risks are saying that unless earnings season blows out, that the biggest next move for the market is a correction, which historically says unless the economy breaks down, you should be looking to buy. So in the meantime, perhaps it's time to start closing out some positions and get ready for the next opportunity. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.